the U.S. House of Representatives was expected to vote on Tuesday on a sweeping, debt-financed tax bill, with approval likely. House passage would send the bill on to the Senate, which could vote as soon as Tuesday evening. Here are the key parts of the bill, which would be the biggest overhaul of the U.S. tax code in more than 30 years. Cuts corporate income tax rate to 21% from 35%, beginning January 1, 2018. Creates a 20% deduction for the first $315,000 of qualified business income for joint filers of pass-through businesses such as partnerships and sole proprietorships. For income above that threshold, the legislation phases in limits, producing an effective marginal tax rate of no more than 29.6%. Repeals the 20% corporate alternative minimum tax, set up to ensure profitable corporations pay at least some tax. Exempts U.S. corporations from U.S. taxes on most future foreign profits, ending the present worldwide system of taxing profits of all US-based corporations, no matter where they are earned. This would align the U.S. tax code with most other industrialized nations, undercut many offshore tax dodging strategies, and deliver to multinationals a goal they have pursued for years. Sets a one-time mandatory tax of 8% on illiquid assets and 15.5% on cash and cash equivalents for about $2.60 in U.S. business profits now held overseas. This foreign cash pile was created by a rule making foreign profits tax deferred if they are not brought into the United States, or repatriated. That rule would be rendered obsolete by the territorial system. Prevents companies from shifting profits out of the United States to lower tax jurisdictions abroad. Sets an alternative minimum tax on payments between U.S. corporations and foreign affiliates, and limits on shifting corporate income through transfers of intangible property, including patents. In combination, these measures with the repatriation and territorial system provisions, represent a dramatic overhaul of the U.S. tax system for multinationals. Allows businesses to immediately write off, or expense, the full value of investments in new plant and equipment for 5 years, then gradually eliminates this 100% expensing over 5 years beginning in year 6. Caps business deductions for debt interest payments at 30% of taxable income, regardless of deductions for depreciation, amortization, or depletion. Preserves tax credits for producing electricity from wind, biomass, geothermal, solar, municipal waste and hydropower. Leaves in place carried interest loophole for private equity fund managers and some hedge fund managers, despite pledges by Republicans including President Donald Trump to close it. These financiers can now claim a lower capital gains tax rate on much of their income from investments held more than a year. A new rule would extend that holding period to 3 years, putting the loophole out of reach for some fund managers but preserving its availability for many. Maintains the current 7 tax brackets, but temporarily changes most of the income levels and rates. For married couples filing jointly, effective January 1, 2018 and ending in 2026, income tax would be